Today we're going to talk about oil and gas investments. There are a handful of good tax benefits that result from investing in oil and gas. The first of these is what are called intangible drilling costs, sometimes called ITCs. So intangible drilling costs are deductible 100% in the year of purchase. These typically run somewhere between 65 and 80% of the total investment. So, under Section 263, the code that governs intangible drilling costs, you can deduct that 65 to 80% in year one. So on a $100,000 investment, you're deducting somewhere between 60 and 85% of that, $60,000 to $85,000 in the year of investment. The second piece comes from depreciation. The part that is not an intangible drilling cost is eligible for depreciation under Section 168. Much like anything that's eligible for depreciation, it is also eligible for bonus depreciation. Currently, bonus depreciation is 40% of the assets placed in service. So applying that to the example I just used, $100,000 is invested, $80,000 is deducted as an intangible drilling cost under Section 263C. The residual amount, $20,000, can be deducted as a depreciable expense under Section 168. Under Section 168K, 40% of that is deductible in 2025 under current law. So as you can see, with a $100,000 investment, a good portion of that comes back as a deduction in year number one. So what happens if you're losing money in the first year? Well, no doubt, if you've been listening to our videos, you know that there's a difference between passive loss and an active loss. And typically, to get an active loss, which will allow you to use that business loss to offset ordinary income, there has to be something called material participation. For oil and gas, Section 469 specifically excludes oil and gas from that active and passive determination. And what that means is if you have a loss in year one from an oil and gas investment, all of it can be used to offset your ordinary income. So what happens in year two? In year two, you're going to get a piece of the depreciation remaining. What happens if you actually start receiving income from this oil and gas well? Well, if you start receiving income, there can be a piece of it that is eligible for omission from income. The piece that's eligible for omission from income, if you do indeed start getting income from the oil and gas well, is related to something called a depletion allowance. So long as it is a small gas well or oil well and is producing less than 1,000 barrels per day on average, then you are entitled to omit 15% of that working interest income that you're getting. Results in non-taxable income. Other types of investments in oil and gas, other than an investment in an oil or gas well, occasionally can take the form of a royalty interest. How this occurs is if there is an oil and gas well that is a productive well, it's currently producing oil and gas, you can buy a profits interest, a royalty interest in this well. The benefit of this is that that royalty interest is also eligible for that depletion allowance. Again, 15% of the working interest distribution, the working interest income from that well, can be excluded from taxable income. If you do buy a royalty interest in a well, even though you get that depletion allowance, that 15% deduction, the 15% exclusion from income, keep in mind that royalty income is taxable at ordinary income rates and is subject to the net investment income tax, much as your other investments are. If you're interested in any type of oil and gas investment, I would urge you to speak with a tax professional as well as the promoter of the oil and gas investment. If you'd like to talk to somebody at Neil Jasani about oil and gas and the tax ramifications, please click on the link below.